Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global landscape. Of course, across the spectrum of the world, we continue to see the U.S. slowly getting a little bit better. We're seeing a massive amount of stimulus coming out of Japan. In fact, if you look at Japan's stimulus that was announced approximately 2 months ago, is actually approximately per GDP or gross domestic product about 3 times the size of the US. This is pretty substantial. Effectively, what Japan's trying to do is reinflate their asset prices, which have been in a decline or a deflation for probably over 2 decades now. So this is actually a net positive. Emerging market economies still seem to be growing at a decent clip, although emerging market large cap equities are greatly outperforming so far this year by a landslide against US-based equities. Our relative strength ranking system, of course, on our global tactical portfolios and our market trend indicators, generally speaking, are still favoring small, mid-cap, and large cap in the US, and they are still favoring small cap emerging markets. Again, I said we are avoiding large cap currently at this point because large cap has been relatively weak. In fact, you're looking at about a 10% net spread or a better return out of small cap versus large cap year to date. Now that may change in the next week, 2 or 3, and of course our portfolio is extremely adaptive to changing market conditions, whether we need to get conservative, whether we should be more growth oriented, or whether we should have more other asset categories that are relatively stronger than what we currently own. I can tell you right now we're looking at a couple adjustments as we get into beginning of next week. As long as we stay on track with what we're seeing, our income-oriented investments that we currently own on the income side of our portfolios based upon our global tactical models continue to do well. We continue to own royalty trusts, mortgage-backed REITs on the publicly traded side. We continue to like emerging market bonds and high-yield bonds on the emerging market side in addition. I think a lot of investors who listen to my updates, of course clients and non-clients, I think learn a lot from what we talk about. We've talked substantially about gold over the last 4 or 5 months and why we don't own gold. And gold, it looks like it's had a temporary bounce and is starting to get a little bit more strength, but again, it's almost at the bottom of our relative strength ranking if we look at all broad-based categories across the board. Now, of course, if gold actually starts to get a little bit stronger maybe over the next month or so, that may be filtered back in our portfolio. But I firmly believe what's ultimately going to happen with gold, it's probably going to stay fairly lackluster because what's happening is the risk-on asset or equity-based as the economies around the world improve are going to blindside the investor who got conservative and shoved all his money or her money in bonds. I firmly believe the investor who's bought traditional bond or bond funds and overloaded the boat, especially on munis and corporate bonds, is really going to suffer the next 3, 5, and 10 years on return. As you're going to see, there's almost no return possible or very little in traditional fixed income bond, mutual funds, or individual bonds. And I firmly believe a lot of those areas are grossly overvalued. So if you look at the next 3 to 5 years, the areas that we are in right now, firmly I believe are going to be relatively strong. I firmly believe investors who are not properly invested, who A, don't follow an investment strategy, especially a strategy that's as adaptive as ours, are really going to have lackluster performance and may lose quite a bit of money in those conservative investments that are really no longer conservative. Remember, we talk to our clients all the time about this. Bonds are really no less risky than the stock market or any other asset categories. Bonds can go up in value, bonds can go down greatly in value, especially if interest rates start moving up. We anticipate rates staying fairly low for at least another 2 years, but ultimately the market will foresee the future, especially in the bond side. And if you own traditional bonds, especially munis and long-term governments, I firmly believe you're going to be a very unhappy investor. Of course, that's none of our clients because we don't own those categories. In fact, because they're relatively weak, and in fact, because of low returns that those have the opportunity to make. So we're avoiding those currently, and I firmly believe that investors who have more of an adaptive strategy are going to be big beneficiaries as we continue to roll out a slowly improving economic scenario around the world. and we stay in those areas that are relatively strong. If you're a client and you have a question about your portfolio, please call the office. If you are a client and you have a referral, we always appreciate your referrals in your business. If you're not a client and you're finally realizing there is a difference in active money management, call our firm for a consultation. There is a difference. We invite you to experience it. Our office number, 800-618-8577. Make sure you listen to my live radio show this Sunday from 10 to noon. For those of you not in the listening area, you can always go on our website to DAR FM and have it recorded, or you can go to iHeartRadio and basically listen to it live streaming video on your computer. Again, have yourself a safe and profitable week. And again, if you're a client, please call us with any questions you may have. Have a great day.